Wall Street resumed a downtrend. Last week, all three benchmark stock indices closed in the negative territory. They slid markedly after Fitch downgraded the US debt rating. Apart from that, Treasury notes surged, which was another bearish factor. The non-farm payrolls report was rather mixed, so it did not help stocks climb. Wall Street rose slightly at the start of the new week. Traders are anticipating the last batch of earnings reports as well as crucial macro stats. Inflation data is scheduled for Thursday, while the producer price index will be unveiled on Friday. Investors will carefully study the reports as they might provide clues about the Fed's future plans for monetary policy. As the earnings season is coming to an end, analysts have started making profit forecasts for the third quarter. During this period, there could be sharp price swings. Watch our video review till the end to find out more curious details. Let's start. The US stock market reacted with a moderate decline to the publication of the NFP report, which growth remains elevated. This indicator makes it difficult to predict the victory over inflation. Besides, the likelihood of further aggressive tightening is also high, which may adversely affect sentiment on Wall Street. Investors are puzzled. On the one hand, the slowdown in employment raises concerns about economic expansion, as it could have a negative impact on the profit of companies and consequently their shares. On the other hand, higher wages may stimulate consumer demand and economic growth, which may support some economic sectors. Now, traders are expecting fresh inflation data. The new figures may lead to a revision of forecasts on the Fed's monetary policy. If so, it could undermine demand for risk assets. The CPI data for June caused high volatility in markets and fueled hopes for a softer stance in the future. All indicators were below their forecast values. The July report should either confirm or refute expectations of the end of the tightening cycle. If the CPI is in line with expectations, market reaction is likely to be muted. However, if inflation rises, it may trigger a sharp drop in the stock market. The CPI is projected to decrease to 4.7% from 4.8%. Fitch has downgraded the US credit rating. However, this event is likely to have a short-term impact on the stock market. When making a decision, Fitch cited such factors as anticipated fiscal deterioration over the next 3 years, weakening governance, and increasing overall debt burden. Apart from that, it also does not exclude a mild recession, another reason for the ongoing aggressive tightening. However, GDP for the second quarter of 2023 surpassed expectations. The unemployment rate remains low. Given these positive figures, analysts doubt the accuracy of the agency's decision. Some analysts interpret this move as a criticism of the US political agenda before the start of the presidential race. On Monday, JP Morgan published an upwardly revised GDP forecast for 2023-24. Economists no longer predict a recession but warn of a high risk of economic downturn. The US economy is expected to grow by 2.5% in the third quarter and by 1.5% in the fourth one. This is a significant increase compared to previous forecasts, which assumed only 0.5% GDP growth in the current quarter and a decline of 0.5% in the next one. In 2024, the US economy is likely to expand by 0.5% in the first and second quarters, as well as 1% in the third and fourth ones. These figures were also revised significantly for the better. However, the risk of accelerating inflation may force the Fed to continue raising interest rates. This could have a negative impact on the US economy. All three major US stock indices incurred losses last Friday. Investors analyzed the latest earnings reports and employment data. The Dow Jones lost ground and ended trading down by 148 points. The S&P and NASDAQ lost 0.5 and 0.3% respectively. This decline came after a 4.8% drop in Apple's shares after disappointing quarterly results. Its market capitalization slipped below $3 trillion. The weekly performance of US indices was also negative. Last week, the Dow Jones tumbled by 1.1%. The earnings season is almost over, so 84% of companies included in the S&P have already published their results, with 79% of them exceeding for expectations. According to FactSet, a decline in earnings per share amounted to 5.2% year-on-year, which occurred for the third quarter in a row. The previous reporting season turned out to be far better than expected, boosting a rally in the stock market. Earnings per share for the first quarter decreased by only 2%, while at the start of the season, a more significant fall of 6.7% was forecast. Apple, Amazon, and AMD have already revealed their earnings reports. Speculators are looking forward to the profit results of retailers. Investors should remain vigilant and closely monitor the trends of the stock market. The S&P 500 sank by 2.3% last week. A downward correction is still unfolding in the market. The stock indices returned to their 3-week lows. The overbought shares created opportunities for short sellers. As a result, they opened profitable positions when a downtrend began. The S&P declined from 4,600, its peak of July 27th. If it approaches 4,450, it will indicate the possibility of a further drop. Short-term traders who have factored in the possibility of an uptrend and opened short positions may soon take a quick profit. The market is likely to experience a technical rebound in the coming sessions, as the main trend is still upward. Short-term sellers will close their positions and bulls will try to buy shares at a lower price. However, on the S&P chart, there is a critical zone of 4,300-200, which was previously a resistance area that turned into support. The price may perform a downward retest of this area as an uptrend persists. The NASDAQ slid by 2.9% last week, maintaining its downward correction. Nevertheless, the main trend remains bullish. Morgan Stanley pointed to the fact that the current stock rally is similar to 2019. Indeed, current data suggests that the rally may be driven by expectations of the end of the tightening cycle. In 2019, there was also a similar situation when the Fed stopped raising the key rate and then began to cut it, while increasing its balance sheet at the end of the year. However, Morgan Stanley also noted a key difference from the current situation. In 2019, the Fed eased monetary policy for the most part of the year, starting in August. At the July meeting, the regulator raised the key rate. Fed Chairman Jerome Powell did not rule out the possibility of another rate hike in September. This leads to market uncertainty, as changes in monetary policy may have an impact on investment decisions and the dynamics of the stock market. Unclear monetary policy prospects create additional risks that should be taken into account when making investment decisions. That is all for now. Follow our updates on InstaForex TV channel. See you!